Are you looking to simplify your investments? Check out BMO ETFs. Your asset allocation can have a major impact on whether you will meet your financial goals, so it's no wonder Canadian investors are turning to asset allocation ETFs to complement their portfolios. BMO offers easy-to-use solutions such as the BMO Growth ETF, BMO Balanced ETF, BMO All-Equity ETF, and more. These ETFs invest in a number of underlying index-based ETFs and are rebalanced automatically. What was once a popular mutual fund strategy is now available through an ETF with the introduction of the T6 units. T6 units provide a 6% annual payout on a monthly basis, helping retirees meet their cash flow needs. This is available on their balanced and growth asset allocation ETFs. Regular rebalancing means you can spend less time planning your life and more time living it. Learn more at bmoetfs.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 87. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, Rich Diaz of Acorn Macro. Welcome back to the show, gentlemen. Keith, what's going on, buddy? How's the forest fires over there? It looks kind of clear behind you.
Yeah, we're now out of the woods. Does that make sense?
Yes.
I don't know, but we have huge excitement in our neighborhood, guys. So our neighbors are going away for a few days. And they asked us, hey, keep an eye on the house, everything. And I'm thinking, this is easy. I like that. All of a sudden, yesterday, the university-age son comes back from school, and he's, a lot older and at that age. Anyway, today, this delivery truck shows up with 3 kegs being delivered. And I'm just thinking, tonight I'm Frank the Tank. This is going to be a fun. It's funny, what kids do when the parents go away.
Yeah, Frank the Tank. I could see that.
Yeah.
That's that's an underrated movie.
I was a model child and I never did any drugs or alcohol until I was of age. And my mother, who listens to this podcast, will be
you got a lot of pent up demand.
I was let's just say I wasn't necessarily the best high school student, but I made up for it at uni. And no, there's nothing going on here, man. I'm good, happy. It's beautiful in London. Went for a bike ride, went for a boat ride. If you ever get to London, actually, you should do. There's something called the Thames Clipper, and for a very minimal price, I think it's like £5, you can take the boat. It's actually called an Uber boat, not to give them a free plug, but basically a boat all the way from West London. If anyone knows, it's Westminster, where the House of Parliament is, all the way to Greenwich, which is a beautiful part of the world. And you can do it for $5. There's my free travel tip for the week. Boys, there's lots to talk about, so let's get into it.
There you go. Huge week, obviously. We got the Bank of Canada, shocking markets, certainly shocking the Loonie Hour. So we'll get into that after our special guest today. We do have a special guest, Robert Asselin. I hope I said that correctly, but he was the former economic and policy advisor to former Finance Minister Bill Morneau. So we're very privileged to have him on. We're going to ask him some questions and get to the bottom of this, because I think it's a pretty important time, right? I mean, we've got there's obviously huge deficit spending going on at a time when the Bank of Canada is trying to work in the opposite direction by taming inflation. So I think looks like we're going to be suffering through higher for longer interest rates. And what does that mean for a highly levered economy? Robert's going to certainly chime in and provide some of his input, which is interesting to have somebody that was, boots on the ground in government. And as we said before, this show does not discriminate, left, right, blue, red, green, doesn't matter your shirt color. We'd love to have you on the show and hear your opinion. So Keith.
I thought
sorry.
I was
we were
waiting
waiting
for,
for
no
Robert.
clever
Yeah,
jokes
me
from you,
too.
huh?
I don't have anything clever to say. I do later, but we'll
Yeah, me
we'll
too.
get into that. But yeah, but obviously today we'll talk about the Bank of Canada afterwards. I'm feeling kind of peckish, so I'm looking forward to my snack I have coming up. But the one
Someone
teaser,
said no lemon loaves.
yeah, I don't have a
That's
lemon
right.
loaf. I have a Twinkie. Here she is. Here she is. And but I think the great thing about yesterday's announcement, for the first time, I think in the history of the global financial system, a Canadian policy decision actually shifted global markets. Like it was a pretty seismic event yesterday, and it just increased investors' views now that, hey, the Fed is now going to hike again. Like everything just got turned upside down yesterday. The bond market got like absolutely mullered yesterday and stuff like that. So yeah, it'll be fun. It'll be fun to dive further into it. Rich, did you find a Twinkie in like the land of no Twinkies?
So let me tell you, I worked hard for the Loonie Hour. I went to no less than 4 stores on Oxford Circus, which if you've ever been to London, Oxford Circus is brutal at best of times. And on a hot summer day with all the freaking tourists that walk slower than a tortoise, I went to four or five different stores. I finally found a passable substitute. So I did not find a Twinkie, but I found something just as horrible. It's from Hostess. It's a ho-ho. I didn't even know that was a thing.
Ho-hos.
So a ho-ho. So it's terrible and terrible for you. But I will eat it because, like Keith said, we got it wrong. We're a little peckish. So
Yeah.
there you go.
If you
Gotta
want to
pay off my
enjoy that,
debt.
you got to stick around for post interview. But let's jump over to the interview right now with Robert Asselin. Robert, welcome to the show. Sorry, I think I actually made a mistake earlier. So you were you were the policy and budget director to Finance Minister Morneau. You wrote a great piece of paper with former Bank of Canada Governor David Dodge, which we all read prior to this recording, sort of detailing the federal government's sort of fiscal plan. And so, yeah, I would love sort of, I don't know if you have any more to chime in on your background and your experience would be great for the audience that maybe isn't familiar with you.
So first, thanks for having me, guys. It's a real pleasure. I think your podcast is awesome. So yes, I was the policy budget director to Finance Minister Morneau for the first 2 years of the Trudeau government. So I left government in November 2017. And by then, the economy was doing pretty well. And we were, at that time, on the fiscal side, pretty close to if we wanted to come back to balance over the forecast horizon. And then, obviously, the government took another direction, which was more spending. And here we are.
This is, you teed it up pretty well. So I have to ask.
It sounds like though you went, it was nice and here we are. Obviously, there's a few things happen between the nice days and here we are. But I know Rich, you're just itching to ask.
I'm biting my tongue because I'm trying to get. No, I don't want to get myself into trouble or Mr. Asselin into trouble. So you guys carry on. I got a questions later.
Well, just a question on that. I mean, you obviously worked closely alongside Bill Morneau. Was I know he's no longer there in that position. You can debate his departing and why it happened, but was his goal and objective to get closer to sort of that balanced budget, and there was sort of a disagreement on the path forward?
Yes, I think these things are public now. He's written a book about it. He's been very clear about what was his core objectives as finance minister. One was growth through productivity, and second was reasonable fiscal track. I think the context in 15 when he came into power was demand was subdued. We did target some investments in infrastructure. The child benefits for the middle class, I think, were helpful, generally speaking. And it was measured, I would say, it was not over the top. And I think he felt that obviously, over time, the disagreement on the fiscal track became more important. And the pandemic happened. Everybody agreed at the beginning of the pandemic that spending was necessary to support folks. But I think the latter part of the pandemic, where it was clearer that the economy was doing a bit better than we originally thought, I think it's where things got a bit more heated with him and the prime minister, and we are where we are today.
What's your Rich? Go ahead.
Well, I just want to say, I mean, first of all, I really like the paper. I just want to give you a couple of props, because I think when people such as yourself write these policy papers, they often are not given anywhere near enough credit. So I think you guys nailed the inflation being sticky. And I think at the time when you guys wrote the paper, that was not a consensus view at all. I know this because I had the same view and I was derided for that view. You guys sort of laid out the similar reasons we've talked about it. So I'm not going to belabor that point, but I definitely want to give you your props. You mentioned at one of the conclusions that there's a significant risk that both the debt ratio and the interest cost ratios exceed comfortable levels. Not to rehash the whole paper that you did, but given that this paper was written several months or quarters ago, can you give us a quick sort of update without any forecasts or PowerPoints?
Great, Richard. A great question, Richard. I think, if anything, what is happening, I would say, in the last few weeks has comforted us in our stress test scenarios. And this is what this paper was about, was to say, okay, what happens if, one, interest rates stay higher for longer? Second, if per capita spending keeps going up, and this has been the tendency of this government. And third, if on the supply side, things get, more tricky going forward. In other words, because of, as a result of interest rates staying higher, kind of the economy being compressed to reduce inflation over time. And when you run these numbers, as you said, you get to levels that are less comfortable on fiscal anchors, both on debt servicing costs, but also on debt to GDP ratio that, as opposed to going down, stay up, as we've seen with the last budget. By the way, they went after they basically didn't respect their own fiscal anchor, which was declining debt to GDP ratio. So to me, that kind of says where we are today. It is possible that, I guess, for some, that things will still be okay in a few months, years from now. I still think a big risk on interest rates staying higher for longer, and also on per capita spending staying higher than they were projected in these budgets. And as a result, if you look at where we are going forward, I think there are huge trends that will make the government bigger in the economy. And I just very, summarizing what I mean by that, the debt is larger. So to finance this debt will cost more to the government, both as a function of interest rates being higher, but also at the size of the debt. Second is aging demographics will put an onus on government spending more money to take care of these people aging rapidly. Third, I would say the relative price of what the government is buying, education, healthcare, is going up, it's not going down. And lastly, if you look at things that are very expensive like defense, I'd be surprised that a few years from now, we won't be in a position where we spend less. In other words, it's quite evident that we will spend more on these things. And I think that's the right thing to do, by the way. So all these things considered, I think the track we are laying down is one that is maybe more realistic than the government one.
Secure your digital life. Did you know anytime you surf the internet, your data is exposed to data brokers? These companies collect your personal information and sell them to businesses for marketing purposes. Data brokers collect your personal information and profit off of it at the expense of your privacy. Let Incogni help you take back control of your data, reduce spam, and prevent scam attacks by opting you out of their databases automatically. Incogni doesn't only remove your data from certain kinds of data brokers, risk mitigation, recruitment, people search sites, financial information, and marketing data brokers. Incogni removes your personal information from them all. Loonie Hour listeners get an exclusive 60% discount by visiting incogni.com/Loonie Hour. And now, back to the show.
So what I really, by the way, I thought the paper was, I don't think I would ever say this for other papers, but it was thrilling. I just love the way it was laid out. And so for people who haven't read it, we do encourage you to go to read it, but basically, without going through everything, but the basic premise is that some of these are my words, of course, and making it sound better than it. No, I'm just joking. But most of these long-term projections and models that are used by governments all over the world, doesn't matter where they are, they're always, they want to present them in the most optimistic like possible, because in the game everybody is selling something in the world, including on the government side, so they have to do that. And then what Robert's paper did, it basically took, hey, what if these 4 different factors change over time? And obviously the inflation outlook, and what happened with interest rates, of course, and growth, and what's the 4th one? I don't remember right now.
Inflation, growth, and supply, the size of the economy, essentially.
Yes, absolutely. And then, and I'm reading this, I'm thinking, yeah, but the big bang, what comes up with this one, everyone who appreciate, you can't have one of those factors happening in isolation without affecting the other one. So of course, the 5th factor, which you go into great detail with, you're demonstrating, hey, if one of these happens, it's going to affect everything. And I think in one of your estimates, you have I think minus 0.9% for I forget which calendar year it is, for a recession coming up.
2023.
Yeah, it's 23. Okay, yeah. So we're maybe that'll be adjusted as pushed, or I guess pushed forward a little bit as we go into it. And when we're reading this ourselves as an investment manager, we like to use the phrase that global risk has been synchronized around the world. And I think if any of these events happens, if it isn't Canada or Europe or the Americans experience it, it's our expectation that minus 0.9 can be amplified even further. The inflation number can be even more. And then the last part that I love the most in the paper is really the interest expense and how that's going to move. And you had a line in what effectively says, but people may not realize that if you have to pay more in interest on your debt, it means you actually have to borrow more to pay that interest on the debt, or has to come from higher taxes. So my question then, like going through all this in the paper, is there guys like us are reading it and talking about it? How much weight is put on this? Is it discussed at different levels of government? Will the big banks discuss it? Why don't you share that background with our
first
listeners?
of all, I should give credit where it is due. Doing this with David Dodge was an immense privilege. He's been at the forefront of this in the 90s when we had a deficit and public finance crisis. So I, from my perspective, he's one of the most credible economists on this issue. And Richard Dion works with him, ran the numbers, did the modeling. So they deserve a huge amount of credit for this paper. I guess it was widely discussed. I know we had an impact in government. I know it was discussed, especially because David was a deputy minister of finance in the 90s, and I think a lot of people respect his opinion and the fact that I was an advisor to the finance minister. I hope helped too. But this is a broader discussion on, for the corporate world, what it means to have higher debt servicing. And what it means, as you said, is at the end of the day, we're going to need more revenues. And that's the worrisome part, is that at some point, you'll need to increase taxes on either income or capital gains or corporate taxes. And none of these options are good because, as you know, we are a highly taxed country compared to others. And this is why this debate is so important now. You want to get ahead of it because when it is too late and someone says, well, guess what? We have to do another GST move. Then it's really not good for the economy,
There's something to be said there with immigration as well, kind of coming in and papering over. I know like there certainly seems to be more of a balanced discussion today around the levels of immigration, just because I think it's putting immense pressure not only on housing but on public infrastructure.
I think I would say we have three simultaneous crises, and I think they are crises on the economic front. The one is the inflation one. We're not the only country that's going through, but it is a crisis in a sense that it won't be brought down easily to 2%. The second is a productivity crisis that has been happening for some decades, but it's now pretty acute. And it does have a huge effect on real wages. We're not talking about an abstract thing. It's real wages for Canadians are significantly lower than Americans on average. And the third is housing. Housing is a huge crisis right now. And unfortunately, it does has an effect on our immigration policy, which generally I've been very supportive of, especially economic immigrants. But because we have this acute crisis of productivity and housing, I think because we bring so many people at this time, it does have a negative effect, unfortunately, on these factors, on these crises. And we just need to be conscious of it. So maybe we do need to adjust a bit in a short term, the numbers. And I'm not advocating for less immigration. To the contrary, I think I have a very liberal, a small L liberal position on this. But when you look at the number, you have to realize that it is putting huge pressure on both housing and GDP per capita.
So can I just touch on that? So the inflation bit, we sort of agree, and I will skip that for now, I think. And I'm really, really happy that you mentioned the productivity bit, because something I've gone on and on about. I mean, spending on research and development as a percentage of GDP is at a 20-year low. It has not gone up in real terms in 25 years. I'm of the view that unless you really increase that number, you do not have improved productivity. And so maybe that we can move on that. On the housing, I mean, on the housing thing, do you see any sort of relief coming through as a function of the programs that have been outlined? Because when we watch question period or answer period or whatever that they call that, we're constantly being told that there's these programs that are being initiated, that there's lots of money being spent, but yet housing starts are soft and weak.
Right.
Contractors our margins are getting squeezed, and there's not enough, and there's labor shortages. I don't care what anybody says. I believe that there's labor shortages, acute labor shortages in specific industries required to alleviate that housing. Do you think the spending programs, not to be overly critical on the current government, but do you think the spending programs and that stuff will move to alleviate some of that, or not at all? Or
I think you've been leaders on this, guys. I've listened to the interventions you've made. You're probably more experts than I am on this, but my view is so far we haven't seen that it has moved the needle. I'm very skeptical of a federal government coming in with a bunch of money in a budget, say we're going to solve this. Historically, it's not how it has been done. Federalism is usually a strength for Canada, but for these things, it makes things more complicated and slower. The permitting side, in my perspective, is a huge problem, and we're just not threatened enough, I find, to move the needle on this culturally. This is true for housing. This is true for the business investment problem, innovation problem that I've written a lot about. We think we do industrial policy, but in my view, we do it very badly because historically we haven't had to do it well, to be honest. We've been privileged by our geography and our natural resources. So the short answer on housing is I don't have a lot of hope, to be honest. I look at the numbers and they seem to be, and I have to give credit to Mike Moffat on this, has been leading the charge. But the numbers, I think, are quite telling. And the gap is just growing on supply and demand,
Well, just to kind of get to that point, because, your paper, you succinctly say that, okay, inflation is going to be probably potentially higher for longer. The deficit sort of spending is obviously, counterproductive to what the Bank of Canada is trying to do. And so I can tell you what's happening on the housing front, which is, okay, so the economy is proving to be a bit more resilient than we expected. Inflation is being a bit more stubborn. So interest rates are higher for longer. And what we're seeing now is a lot of these new development, these housing supply projects are actually no longer feasible because the cost of capital has become so expensive that these projects no longer pencil. So what we're actually seeing is we're actually seeing a lot of these projects are dropping like flies and they're not going to be built. And so I actually think that won't create necessarily a supply problem today, but you talk 3-4 years down the road, as obviously all levels of government are trying to encourage the private sector to build more, it's actually turning off right now.
Yeah, no, I can see that. Absolutely.
I have another question as well. When these conversations and planning is taking place in Ottawa, so at the public sector side. Are there any discussions about other economies, other countries, and maybe like external events that, you know, they have a non-zero event probability of maybe occurring that could affect what happens here in Canada? Is that discussed? And if it is, like at what level and extent? To give us an example, if you could.
I can speak from my experience at the Department of Finance at the federal level. I can say the analysis provided is top notch. They are totally on top of it. They have the data, they have the forecast, they speak to the right people. The modeling is pretty good as far as models can go. So I don't think the problem is in the analysis, and this has been talked about for a long time, certainly when I was there, and it wasn't as acute as it is today. So I think people saw this coming. The issue is really on how do you confront this as a country, given the federal, provincial, municipal. So yes, you know, the comparative aspect to other countries might be helpful, but some countries, because they have less levels of governments, they can move more quickly on this stuff. So Canada, it makes it always more challenging. You know, I go back to the federalism kind of obstacle in these instances where I find you need to talk to a lot of provinces. It takes time. They don't agree. It's not the same in every city. And so this is why I think as a country, to be honest, if I look at the last 5 years, we haven't moved as fast as we should have on many things, including housing, because historically we've not been good at moving fast. And I think culturally that's become a big disadvantage for Canada.
Can I ask another question? So, I mean, the way you've sort of highlighted something, and not to put words in your mouth, but there's like sort of a fight between sort of the pragmatists and the technocrats, who I agree with you are top notch. I mean, your CV, frankly, not to make you blush, is quite impressive. And then sort of the idealists. And I understand that this conflict is not unique to one side or the other. But would you say that this government suffers from, you know, policy that's dictated and dominated by dogma rather than one that's, you know, let's just say has a kinship with reality? I mean, and I would use energy as my personal bugbear, but please carry on.
It's a very astute observation. Certainly, liberal governments in the past have been very pragmatic. That's been my experience.
I agree.
This government has been more ideological than others, in my opinion. And this is not in any disrespect to the people who are serving in this government. I think their art is at the right place, but I do think they have an ideological bent that government has to step up on every public policy problem with big dollars, and somehow it will solve it, which I don't think is a pragmatic view of how it works in practice. And so I would say that on the implementation side, there've been a lot of shortcomings. It's okay to say we're going to come in with this national housing strategy. It's another thing to actually implement it. And if you look at a lot of the things they've been announcing in the last 3 budgets, and I go back to the budget, the first budget of Minister Freeland in 2021, when they came with this 140 billion stimulus budget, you will recall, which I think was absolutely unnecessary and has proven to be very inflationary because the economy was doing very, very well at that point. You have a tons of measures in these budgets that, in my view, are well-intended, that are, of course, meant to do well, but that in practice, if you look back 3 years after, you would struggle, I find, to find impressive outcomes for any of these things that have been announced. And I would actually go further and say that in a lot of instances, they have not been implemented yet. So that tells you a bit about sometimes our government can get trapped over its own kind of goodwill.
Robert, do you still have friends kind of higher up in the party there or in government right now? I
do. I have a lot of respect for many friendships with ministers and people who serve in the government and work really, really hard. I try to voice my disagreements the most respectful way I can on policy ideas, not on personal intent. I don't accuse anyone of bad faith. And I think as long as it stays that way, I hope it is helpful, you know.
What's the current sentiment, amongst your peers there?
My sense is, to be perfectly honest, there's a sense of a certain fatigue that is normal when you've been in government for a year, especially after the crisis they've been under. To come to their defense a bit, the Trump presidency, then the COVID crisis were not small in terms of scope and scale of crises for any governments who would have been there. I think would have been huge challenges. So you have these people who have been through these crises, that have been in office for 8 years now, almost. You can feel sometimes they are a bit stretched, a bit tired, which is totally normal. And there hasn't been a lot of renewal around, in my view, around the prime minister and key offices. And then there's a natural tendency that happens in government is that once you come in, you have a clear plan. I'm proud to say I participated in the 2015 platform. I thought it was pretty comprehensive, centrist platform, reasonable platform, I would say. But as it happens over time, government get maybe less inclined to move with new ideas, and you can kind of feel it through the governance. They react more than they initiate, I would say. And when they initiate, sometimes it's done a bit on the back of a napkin and not well thought out. And this is not just for this government. I think this is a universal comments for governments who have been in office for a long time.
I have another unrelated question for you. I think it might be the last one, maybe. What are the discussions around the possibility of a sovereign debt bubble and or a private sector or credit bubble? Because right now today, of course, one interesting shift that's taking place in the marketplace, pension funds everywhere are now shifting to the next biggest, greatest thing, which is private credit.
Yeah.
And the only thing that's great about private credit is that there's no mark to market. So they don't have to mark on their books on a regular basis. But like within the public sector, like, is there a conversation that says, like, my God, if the 10-year goes from 3 to 5% for 18 months, we're screwed? Or like one of the headline quotes we're always seeing now coming up Ottawa is two things. One, it is comparing Canada's debt to GDP level to previous periods, and also on a G7 basis and stuff, and which makes me cringe, of course. But there's no mention, absolutely, and there's no mention though of household debt, because almost every single metric for households at the Canadian level, like it's not only shocking, like it should scare the bejesus out of everyone. Yeah. So we could be in a situation where, hey, public data points look fine, like we can get through them. Right. But if something breaks on the household level, then all of a sudden we're back to another 2020 kind of bailout taking place. Towards the private sector again. So share a little bit about that, maybe.
Your question is really good. I try to look at debt overall from a very basic point of view, which is supply and demand. And when I look at it today, the supply side is pretty big, which makes me worry. At one point, at any given point, you have to have enough people to want to buy your debt, whether it is corporate, private, public. And given interest rates, I think real interest rates will get higher as a result of the debt out there. I think it will be a natural phenomena that, interest rates on debt in general will be higher, and that will create a huge pressure. So I totally share your, I guess, your concerns. And I think the aggregate amount of debt out there is becoming to be a bit scary, and it could cause a lot of problem in the economy. So because we have become a service consumption-based economy, not enough productive, that puts an additional onus, I would say, on Canada that a lot of other countries don't have. And again, going back to this housing crisis, I think this is something I'm personally quite worried about.
That's yeah, Robert, really appreciate taking your time. I just had one last question here, and I don't know if you can comment on it or not, but I know you're with Morneau there until November 17, roughly. Any comments around I'm in the housing frontier, a Home Capital Group, and the deal that was struck with Warren Buffett there?
I don't have any comment on that. I don't feel I'm in a good position to comment, to be honest.
I had to ask it, so
I'll play safe on that one.
He's been such a lovely guest, and you're trying to get him in trouble.
Okay, I was against that question, by the way. I don't think.
Good
sorry,
for you to ask.
I was saving that one up, but we'll leave it at that.
I think a better question is: do you have a variable rate mortgage, or are you on fixed? That's probably the better one.
Yeah, I'm on fixed, but worried about renegotiating in a year from now.
Okay. Yeah, that'll be well, you're smarter than most fixing in there. So yeah, Robert, thanks again for coming on the show. It's been a pleasure. We'll link to your report so the rest of our audience here can take a peek as well.
Thank you so much, guys.
Merci beaucoup.
Merci, au revoir.
Yeah, that was an awesome interview. I think I was smiling the whole time, just listening to this guy. So
I was nodding.
I don't think Rich has any hope of getting hired by the government down the road. No, maybe
the mystery around Warren Buffett remains to be demystified.
Guys, listen, I'm feeling kind of peckish. What about you guys? Dun, dun,
Me too.
All right. Well, yeah,
we all lost. We all lost the bet.
I'm ready.
This is the first time in Loonie Hour history that you've had all three of us lose the bet. We're all on one side. Shows you how much we know. The Bank of Canada obviously raising rates 25 basis points. So let's get into it.
Do we all eat at the same time, or do one of us talk while we go?
Yeah, somebody take it away.
All right. So on my Twinkie, it says best before the year 2085. This is good. This is going to take it. But let's just start. While we're enjoying our snack here, Rich, is it a little Debbie? What do you have? What is it?
No, it's a ho ho.
What? Ho who?
It's a ho ho, which is not reflective of my social life. Anyways, it's a product from Hostess, so it counts.
Let's see the box. Let's see the box.
Looks exactly the same, to be fair. There you go.
Ho-hos.
So right now, Steve is, here we have the king of Kitsilano, probably the only guy there in the neighborhood enjoying a Twinkie. But let's get down to it. I
gotta get a box of ho-hos for the holiday season coming up next year.
Okay, Rich is going, man, you're chowing down on that, Rich. Steve, why don't you run through then what happened with the Bank of Canada announcement, and then we'll go from there with market reaction, and where do we go from here? Because it was a pretty it's one thing, like we were all we all predicted or forecast that there would not be a rate hike. I thought there'll be either like a dovish hike, they would hike and then not say too much, or there'll be no hike but be very hawkish, with their language. Of course, there was no presser yesterday. They just had the in the report come out, and just for everyone to realize is that it was a complete shocker. And the reason that because it completely moved almost all markets around the world. You get this sort of snowball effect, or bootstrapping, right, Rich, from your CFA days?
Well, it wasn't priced in. So you remember we always talk about things like OIS spreads and forward OIS and bankers acceptance notes and what they do. And
are you sure? All of Twitter seemed to know that they were hiking rates.
Well, not the people who counted, not to be a total jerk about it, but the expectations on the Bloombergs and all that stuff. It was non-zero. It just wasn't. Sometimes it's 95% chance, right? The probability. Anyways, let's not.
No. I mean, let's be honest. Keith. Let's call it what it is. The bond market was not expecting it. There was a very low probability. There was larger probability that if the bank had moved, it was probably going to be in July. They were maybe going to give us a bit of a preview here in June and say, okay. And then you can kind of forecast out, but he didn't wait this time, which yeah, it was definitely surprising. 25 basis point move. I mean, the mark that I watch basically is the Canada 5-year bond yield, because that's pricing your 5-year fixed mortgage rate, which is what most Canadians care about. That moved up about 20 basis points on the day, like instantly, as soon as the market,
so that's one hike.
Yeah. So, I mean, and like, I can tell you, like, leading up prior to the announcement, I had conversations with pretty much, 3 of the 5 large banks. All of them had, all of them were increasing their fixed rate mortgages prior to the meeting. They were all moving up by about 20 basis points. So who knows? Maybe they knew something, but no. But like, seriously, so all your fixed rate mortgages were already moving up. So I think we're going to see another repricing potentially after this move, given where yields have gone. So we're getting close, not quite. We're getting close to the highs of about the fall of last year, when mortgage rates, like your 5-year fix, would have been like 5.5. We're getting very, very close to that number right now, and we might just get there in the next couple of weeks if this continues.
So what's interesting? So right now the market is pricing one more hike, so another 25 points coming up, and it could be as soon as July 12th coming up. But this is what I would have done, and not that it matters, of course, but it matters to me. So if we're sitting there, and what I mean by that, if you're on the committee at the Bank of Canada, on the Board of Governors, you're sitting down, you're going through everything, and it's in agreement that, you know what, we're still a little bit behind the ball here. So we have to do something. And the policy response in that situation, it should have been a 50. So I think they could have done a 50.1, because if you're going to shock the market, just shock the market, because they need a recession. Again, I keep saying that all the time, but the only way they're going to really control inflation is to crush demand. And the way you crush demand is by having recession, which means job losses or no bonuses and stuff like that. I mean, the cost of financing is more expensive. So by doing another 25 again, they want to have, their Twinkie and eat it too, right?
Do you think one of the sole purposes?
That's what we're doing, though. We're doing the same thing.
Do you think one of the sole purposes of the hike was merely just to try to shock markets, to get them out of this sort of? I think personally, looking at the housing market, and I've said this before, it has not been a demand boom. Like, we've seen prices going up across all these markets, but over the last 5 months, it has not been a demand side boom. It has been a supply driven issue that has pushed prices up. But clearly, I think people have been a bit lulled to sleep, which is, the Bank of Canada moved to the sidelines. They're on pause. This is probably as bad as it's going to get. And they've been willing to sort of re-engage in bidding wars and push prices higher. And so perhaps, he's trying to sort of shock that mindset or that culture that we've created over 30 years.
I think that's a good point. I mean, I would like to give us some props, because a couple of things that we've talked about consistently, which is sticky services, population growth, and housing. So the reason why I'm saying that is because if you look at the actual press release or whatever, you can see it's freely available. He talks about that in the third paragraph. They talk about, strong demand for labor. Overall excess demand for the economy looks more persistent than anticipated. And why is that true? And one of the things we've been harping on over and over again is when you have population growth of such excess, it's very, very, very difficult, right? We have two, forces pushing in the opposite direction. And I think that it's really interesting that they cite that, as well as they talk about, the stickiness in services, which is, again, something we've talked about, not to belabor the point. And my sneaking suspicion is that Tiff Macklin is an avid listener of the Loonie Hour, but that has yet to be confirmed. But the other thing was that immigration and labor component sort of speaks to the fact that it was going to be really, really tricky to push down inflation. And so unless you have some of those, like Keith says, unless you have demand come down, and demand can come down from different perspectives. It can come down from job losses, but it can also come down from lower immigration or, let's say a credit contraction, what have you. And I think it's just interesting that they highlighted a bunch of those issues. They also talk about how the fact that, a lot of the reason that inflation fell in the first place is because of lower energy costs. Well, guess what's stopped? I mean, the year-on-year change in energy costs has gone to zero and will probably stay there. So it's interesting how it's touching on a lot of the stuff that we've touched on. We just got the date wrong.
Well, just to chime in on, like, this is why we're so excited to have Robert on the show today, which was like the same day that the Bank of Canada raised rates, which is they're trying to sort of kill demand, as Keith said, get that recession so you can get inflation down. You had Finance Minister Chrystia Freeland out, and I quote, she says, "We are coming to the end of this difficult path out of the COVID economy. The destination is stable, low inflation, and steady, strong growth. And that is the direction that we're heading. And as of right now, for those that aren't paying attention, they are seeking approval in Parliament to push another $20 billion of deficit spending." So I don't understand it, to be honest. It's just like, if I'm Tiff Macklem, it's just like, dude, what are you doing? Like,
well, so Rich made a good comment, that, the Bank of Canada, they're listening to the Loonie Hour. So here's how the conversation went. They get together and say, "Hey, what'd you do last night?" "Oh yeah, I was watching the Loonie Hour." He said, "Yeah, did you hear Saretsky call the bottom in the housing market a couple of months ago?"
5 months ago.
5 months ago. And he said, "Yeah, we'll just wait till this afternoon. We'll show him." Right. That's what would have the way it went down. Okay, so that's it, guys. I mean, the Bank of Canada, but the other thing, remember, I always try to bring everything to a focus that's not just Canadian centric. But the same day, the Royal Bank of Australia, the RBA, Australia
day before, I think.
Day before?
Yeah.
Well, the day before in Australia is tomorrow here.
Okay.
That's way too confusing.
That's like a Simpsons episode, I think.
Yeah, that is.
Yeah, it is. However, they raised rates again. There's a bit of a shock. Now the Canadians did it. And now all of a sudden, there's momentum building that the Fed will raise rates again. I think the Fed was going to raise anyway next week. We also have the American CPI data coming out next week as well. So next week will be some fireworks in monetary fixed income world. Rich,
and don't forget that the non-farm payrolls came out better than expected last Friday. Which was also a shock. So, and the previous months got released. So you have solid labor market. I mean, again, not totally solid, but you know what I'm saying? That specific number was great. And so we have the RBA, BOC, and then this is sort of a setup for the Fed. And as you always tell us, Keith, all the central banks sort of talk. They're on a giant WhatsApp group, and they probably talk to each other. So I feel like the BOC probably knew something was coming down the pike before any of us did. Maybe.
Yeah, maybe. And anyway, I mean, yeah. So that's now where we're headed. So we're down. We're headed down this journey, not Aerosmith, where, a higher interest rate or tighter interest rate policy, it hasn't ended yet. Now, as a reminder, that the Americans have yet to pause, like they're still continuing down that path. And, it's funny because everyone, in central bank world, everyone wants to be Volcker. They all will be Paul Volcker until the time comes to be Paul Volcker. So we'll see what the Americans do next week. But there she was.
Yeah,
Yes.
no, I'm curious your thoughts because, we've talked about it on the show, which is like it's incredibly unusual for a central banker to raise rates, pause, and then the next move again is a hike. Usually, once you pause, your next move is typically the cut. So we've kind of gone on that. Now I'm curious, like, on your personal opinion, how are you looking at this from, like, if you were a central banker? My view personally, again, hey, this guy's in real estate, so maybe I've got a bit of a bias, but I just look at it and say, how lagging are these rate hikes? Which is like, we've talked about on the show, only 1/3 of Canadians have actually seen a mortgage payment increase. So a lot of this hasn't necessarily filtered through. We're only just now starting to see it sort of filter through on housing construction. Rich, you'll chime in about how large a sector, whether it's right or it's wrong, construction is a huge component of this Canadian GDP. So Canada building permits dropped 19% in April. to the lowest level since December of 2020. And I would consider building permits to be one of your sort of leading indicators. But then again, like, you know, maybe on the lagging side, you've still got like relatively strong GDP. So it's like, is it, in your opinion, if you're a central banker, is this the right move? Or do you think they overdo it?
No. So if we're in a central banker body, right? So there's arms, legs, two eyes and nose, and maybe something in here or maybe not. I say that just to get Rich to laugh, of course. They're just trying to do what's to achieve what their policy mandate is. So for the Canadians, is they want to focus or target, try to achieve a certain level of inflation. And where they've been surprised so far, you know, they've gone from, you know, basically 0 up to 4.5, you know, very, very quickly. And it hasn't been that much of an impact on inflation. I would argue, and I think Rich has talked about before as well, you know, a lot of the slow, remember, inflation has not declined. You know, we all know that, but you know, the media will say, oh yeah, inflation is down. This one, it's just growing slower. I mean, that's all it is. But a lot of that is simply been, it's just year-over-year effects, and you know, some mark like energy has come down quite a bit and stuff like that. Has it really been caused by central bank rates? And that's where I think they're disappointed, because they went from 0 to 4.5, you know, very quickly. And in every central bank, you know, textbook that they're reading, you know, we should have had a significant pullback in the economy by now. Like it should have happened. So that's why they're sitting there. You know, you guys don't remember, but there used to be the head of the Fed was this guy, Alan Greenspan. That was a long time ago for you kids.
I remember him. Come on.
And but you remember, like, you know, he was turning into this demigod, and you know, like years later they discovered he wasn't. You know, he was just the old man yelling at the clouds. But at one point, though, you know, they were talking about how the economy, because back in the early O's, the U.S. economy was growing at 4, 4.5, 5%, and where was inflation? It was nowhere. Like it was unbelievable. And he used the word at the time. He said, this is a conundrum. And what the conundrum was really at that time, it was literally globalization. Like everything was being offshored or onshore, depending on your perspective. And everything's just moving to the lowest cost manufacturing jurisdiction, you know, whether it's China, Asia, South America, Mexico, it didn't matter. And that was more than enough, you know, to soak this stuff up. Central bankers today, you know, they have the exact opposite situation. Like globalization is now effectively dead. I think Rich disagrees with that sometimes, but you know, for all intents and purposes, it's no longer like all the easy efficiencies. They've already been squeezed out. That's happened. Right. That lemon has been juiced. Like that one, Rich. That lemon's been juiced.
I prefer turnips, but anyway.
Okay, and but then of course, you know, they're dealing with, you know, if you shut down the global supply chains because of your, you know, your horrible policy response to the pandemic, and you do not reduce, you know, aggregate income at the same time, of course, inflation is going to go through the roof. You know, of course, supply chains can't get, you know, restarted again. So see, like, you know, they're trying to get things to where they want it to be, and they're using yesterday's tools, but it's just a different ball game they're in.
That brings me to my next question, which is like, I've heard the argument from a lot of smart people. And again, I know there's going to be tons of people that disagree with this, but it's interesting because it does make you think. I've heard a lot of compelling argument, some from, you know, one of them was from Professor Richard Werner, who invented quantitative easing, the terminology that raising interest rates doesn't necessarily have a correlation with falling inflation, and vice versa. Like, you know, we were in what, the last 10 plus years of zero interest rate policy, and just, you know, I mean, Japan's been doing it for 20 years, can't generate inflation. So it's like, I don't know, I think, is there an argument to be made that central bankers believe that they can control everything with this lever?
So can I take this one? I mean, so I think the short answer is yes. I think that there is absolutely an argument that this idea that only one market lever works. The longer answer is to say that raising interest rates has no effect on aggregate demand or credit demand, I think is wrong. If tomorrow the Central Bank of Canada put interest rates to 15% and said, screw you, we're holding them here, trust me, that would affect people's decisions. And I think the mistake I fall into, and I think loads of strategists fall into and market commentators, is that it's just never just one thing. It's a very complex, multivariate world that we live in. And I think that if you raise interest rates in a world where, for example, household debts are extremely, extremely high, and they're highly tuned to that short-term number, I think you have an acute impact. However, right now, mortgage rates in the United States are 5 or 6.25%, whatever percent. And because all of the households borrowed 30-year fixed rates at 3%, there's almost no connective tissue between those two levers, right? The fact that the Federal Reserve is raising short-term interest rates is not at all affecting the interest payments on a person who lives in Kentucky's mortgage payments. And so there's no connective tissue there. And so I think the shitty answer is that I think it depends, but the short answer is I think, yes, you're right. I think it's worth discussing.
It's interesting. I don't know if you guys saw that piece, but the credit spigots are certainly tightening. There was that note circulating there on Twitter. There was somebody posted that their CIBC unsecured line of credit was going from prime plus 2.25 to prime plus 5.25. Which is insane. And so, if you're starting to see some of the banks doing that, I think we're going to see the credit spigots tighten. So it'll be interesting to sort of see how the economy and these highly levered households digest that, not having access to lines of credit, essentially.
So my biggest fear right now is that I think we're getting closer and closer to a high potential for a massive credit crunch coming down the pipe here. Whether that's been, brought forward faster with, monetary policy from the last 48 hours or not. It's getting close, guys. I think it doesn't mean it has to happen, but the probability is certainly there. And my God, if it does happen, it is one thing, from an economic perspective and everything, but all of these like traditional balanced fund mandates are just going to get smoked, because it's funny, right? Because, you hold bonds in your portfolio to help reduce your risk to holding equities. However, equities are not a way to reduce your risk to the bond market, because you get a credit event, they're both going to, get it up the nose. But this is, and again, I mentioned earlier, I think I asked the question when we had Robert on earlier, when I'm starting to see now everyone's going into private equity, private credit. And again, the main reason for that is there's no mark to market. You can sort of wait it out and see what happens. But because institutional money is now buying private credit, it means they're not buying public credit, or not as much of it. They're not completely out of the market. But that just tells you something. You have to connect all this together, and it's a risk market we're in. And I think that, risk has just been notched up a few levels, Rich.
So I agree with you. I think that's a really, really, really good cogent point. And I think you're right, that is a risk. The problem I'm having is reconciling nominal GDP growth of 7% in the US or 6%. Notice I didn't say real. I mean, I'm saying if you have sustained high nominal GDP growth, and that's a conversation for a different day, but I'm just saying if your top line number continues to tick over at a relatively high pace, it makes a lot of the debt issuance and the debt sort of the payback issues you might have, the refinancing issues you might have at that private credit level much, much easier to swallow. I know this because literally my client has literally just told me that on Tuesday. And so if you have that top line growth, even though your returns won't be as good, it prevents a severe dislocation in those credit markets. But I think we should move on to other stuff, because I think, Keith, you had some, or maybe some pushback perhaps, but I think there's loads of stuff.
I'll frame it up for you, Boomer.
Sorry.
Well, we were chatting about big deficit spending, and I think Keith. I think that Russell Napier, we got to have him on the show because I really feel his financial repression theory of like sticky inflation because governments just can't get their hands off printing money. We've got the England coming up with a UBI test run of universal basic income. Rich, what's the scoop over there, buddy? Your feet on the ground.
Well, no, I think this one's Keith, because Keith's always telling us that, other governments, they're all connected. Risk is synchronized. I agree to that to a certain degree, but I definitely think the political risk is synchronized, and there's a trial balloon, Keith, and you wanted to let us know on a couple of trial balloons that we're sort of seeing here.
Keith salivating over there. He's going to retire and go on UBI.
We always spent a lot of time on it, but remember, the Canadians aren't acting in isolation or on their own. But I got a lot of things that caught my attention this week. But one, there's a small group in England. They're going to start receiving, I think it's 1,600 quid a month they're going to get. It's on a trial basis, and they'll see what happens with it. And so just imagine if everyone receive this UBI, universal basic income, they call it. So obviously people have more money. Okay, Steve, this one's for you. What happens to inflation?
I don't know. Those people got a lot more money to spend.
Yeah, it's going to go up again. But that was one thing. And again, of course, and that's what it ties in the whole central bank digital currency stuff. I think we're talking about in this.
Yeah, it becomes easier to distribute too, right?
Right.
Yeah, they're all. It's just awkward where we're going.
When are we eating the bugs?
It really is. Yeah, we eat the bugs. But you want to talk about the Cato Institute survey? I know we were talking about it earlier. Do you want to go into it, Rich, or do you want me to?
No. I want you to go for it because I think you had some really good points.
Yeah, and so Cato is. By the way, I love the name Cato. Who was the?
It's a Greek god, isn't it, or a Roman god, or something?
Well, I thought it was like Batman's left-hand man or
no,
something.
What was he? Who was Cato? Word.
He's
a philosopher or something like that.
Actually, I think it was the guy that lived in O.J. Simpson's pool house. His name was Cato, wasn't it?
Yeah, he was a Roman statesman. I was right. He's a philosopher / Roman statesman. Thank you,
No,
Internet.
not the guy that lived in O.J. Simpson's
right-hand
pool
man.
house. Yeah.
Oh, the Green Lantern. The Green Lantern. Anyways,
have we hit a new low yet? Has this been a new Loonie Hour low?
Show's taking a turn for the worse.
Okay, here we go. So anyway, this huge survey, a lot of things, but they were surveying Americans on central bank digital currencies. And because we talked about it a few times, we brought it up again a couple weeks ago, but there's a whole bunch of questions here, but 3 jumped out at me that I wanted to share with everyone. So 68% of Americans oppose central bank digital currencies if government could monitor what people were buying. Right?
Obvious.
Makes you wonder why the other 32% are comfortable with that. But anyway, again, like no secrets. They're going to know what you're buying. 70% of Americans fear government will turn off their access to their money.
That's never happened in Ottawa.
That will never happen in Canada. My God. And by the way, anyone in Ottawa listening to this, it was horrible to do that. You never do that, guys. Number 3, the biggest concern with central bank digital currencies, you ready? The government will control your personal spending. And that's some fray. I heard one of the English politicians rating on this a while ago and what they could do. But again, it doesn't matter what is correct or incorrect with those 3 points that I pointed out. But it's being talked about. This is what people are believing. So I think central bank digital currencies, it will not happen in the US. It's going to be very difficult. If it does happen, the value of a physical US dollar is going to go through the roof. Canadians will accept it with complete blind faith and trust, as will most of Europe and my God, New Zealand. Like they'll do it every day of the week. I think they would. But it's what's great though that it's being discussed. There are surveys out about it, and there are some very strong feelings about it. But what did you see, guys? Did you guys go through the survey?
Yeah, the only thing, there was two things for me that caught me in the survey was a lot of people didn't know what it was, which I shouldn't be surprised, but I was surprised. I think a fair number of people said, they didn't know what it was, rather than having a view on it. And that's fair. It's a relatively new thing. So spread the word central bank digital currencies are bad. But the other thing that I thought was really interesting was, the other thing I think is really important is people will say, that's not true. They don't want to control your spending. Again, newsflash, just go on the websites of the central banks, the ECB, the BOC, the BIS, which is the Bank of International Settlements, which is the central bank. This is explicit in their language. That is exactly what they want to do. So I was actually quite pleased to hear that a bunch of people were sort of cotton on to that. And they were reading their own literature. Go ahead, sorry.
Oh, I think we have to be like realistic and say, how many Americans know who Jerome Powell is? Like
very few.
I would,
or Tiff Macklin, or how many Canadians know who Tiff Macklin is, or whatever it is.
Exactly. I mean, obviously, this is
he's the guy that watches the Loonie Hour.
That's right.
This is a podcast for geeks, right? Like, let's be honest. But and we love you all, but like, let's call it what it is. I think if you were to go out right now at the end of this episode, go text 5 of your buddies and ask them, hey, do you know who Tiff Macklin is? I'm confident at best 1 in 5 will probably answer that they know
Fair.
who he is. So the fact that you're now asking them, hey, what's your opinion on a central bank digital currency? It's like, come on.
Yeah, that's fair.
Okay, for the next, weird and wonderful observation for the week. Way over in Japan. Guess what happened in Japan this week? Anyone? Okay. So everyone, I think most people know, the Bank of Japan have been buying up ETFs all the time. So that's part of the quantitative easing program. Not only are they buying Japanese government bonds, but they're buying equities.
They're some of the largest shareholders.
Yes, they are. Absolutely.
It's wild. Could you imagine Tiff Macklin just sitting at the board there? Hey, I'm your largest shareholder at the TELUS Corp.
I know, yeah. It's all ESG driven.
You beat me to it. I bit my tongue, Keith.
DEI and all that stuff.
I was gonna
anyway,
say.
So with the Japanese, what's being discussed over there? So there's the BOJ. They have about 380 billion. Let's round it up. Okay, it's only billions. $400 billion worth of equity ETFs right now. That's what it's worth. Their book value is about 260. So there's about 140 billion they've made in, profits.
It's been a good trade.
Yeah, of course it has. Man, if I could buy stuff for free money all the time in the market and not worry about it, and I'm making money all the time.
I got some pre-sales for you, buddy.
So the great thing now is, so remember, that's the central bank. On the Minister of Finance side, they're trying to figure out a way how the Finmin, to the government, can buy this book of ETFs from the BOJ at book value. So a $400 billion portfolio, they want to buy it for 265 billion, right? Or 260 billion. And then the plan then is to distribute it to the population.
Jeez, I wonder why there's inflation. Weird.
But again, like, that's the next weird and wonderful thing that they're trying to figure out. So it comes back to, how do you know it's the end of the world? You're trying to do
shenanigans.
A market value for book value swap and give it to everyone to spend.
The Loonie Hour should start distributing equities at the next live event.
That's right.
Maybe we should do an IPO for Loonie Hour Media Inc.
We're gonna get in trouble with the regulators. So let's take that back.
Yeah, that's a fair point.
Yeah,
okay,
we're taking it. We're going back. We're taking it private.
I got a few other things, but nothing that else I need to share.
I think we got to cut you off. We're running a little long here, so I think it's a good place to end it. We do have the show is booked for July 27th in Vancouver at the Hollywood Theater. I think it fits about 300 people, so it should be a great event. July 27th. Tickets will go on sale in the next couple of weeks. You guys will be the first to hear about it, obviously. So stay tuned for that. Mark your calendars. Would love to see everybody in person. And as always, Appreciate the support. Thank you so much for tuning in. Continue to spread the word of the Loonie Hour here, the gospel. Leave a 5-star review, share with a friend or family, and we'll see you next week.